Hi, I'm Scott Olson, co-founder of LTCshop.com and author of Long-Term Care Insurance Now. This year, 2026, we're sharing 26 client profiles. These are not hypothetical examples. These are real people who are really my clients. They purchased real policies. And I'll share with you the real premiums and the real benefits they have. I'll also discuss their health histories and why I recommended one policy over another. The only thing that is fake is their names. Can someone with chronic kidney disease qualify for some type of long-term care insurance? If someone needs dialysis, there's no long-term care insurance solution. If someone has chronic kidney disease in combination with diabetes, that's also pretty hard to insure, but they might be able to qualify for an annuity with a long-term care rider. There are several past episodes where I discuss annuities with long-term care riders. In those episodes, I explain what to look for and what to look out for. Now, keep in mind, when shopping for long-term care insurance, the healthier you are, the more options you'll have. And the healthier you are, the lower your premiums will be. So don't wait. If you have enough income or assets to protect, to justify the cost of a policy, don't wait. Buy it now. Go to my website, ltcshop.com, click on Schedule a Call, and we'll get the conversation started. First, we'll discuss Wanda, who has kidney disease, and her husband, Paul, who's in perfect health. Wanda is 59 years old. Paul is 59 years old. Both of their mothers have long-term care insurance, and the policies are helping their moms get great care. One of them's in a first-class assisted living facility, the other in a beautiful memory care facility. Wanda had a kidney transplant several years ago due to polycystic kidney disease, PKD. And she takes anti-rejection medications so that her body will continue to accept the new kidney. And she'll have to take those medications for the rest of her life. There are only a few companies that might approve an application from someone with a history of PKD. Wanda's kidney functions are good. They're not perfect, but they're good for someone with one kidney. In her case, I recommended they purchase an annuity with a long-term care rider for several reasons. Number one, the underwriting is more lenient. Annuities with long-term care riders are basically high deductible long-term care insurance. The insurance company, in this case, the insurance company incurs no losses for the first 30 months of care. Therefore, the underwriting criteria can be very lenient. Second reason, Wanda and Paul wanted to get as much benefit as they could. There was another policy Wanda qualified for, but it had lower benefits. They didn't want just 1 year of benefits or just 2 years of benefits. They wanted something richer. They wanted benefits that would last as long as possible. They especially wanted to share benefits as a couple. Sometimes that can be a very economical way, a very efficient way of maximizing coverage and minimizing premium. Third reason, they did not want high recurring premiums every year throughout retirement. They wanted most of the cost to be paid upfront in one large lump sum. Most of their assets are in traditional 401ks and traditional IRAs. They wanted to pay for all or part of the coverage using one single lump sum transfer from one of their traditional retirement accounts. That's easy to do. It's called a trustee to trustee transfer. And there's no tax consequences when making that kind of a transfer. Lastly, since Wanda is self-employed, they decided to pay for the long-term care rider on a monthly basis rather than in a big lump sum. Paying it monthly could allow them to get a tax deduction each year through Wanda's business. It's called the self-employed health insurance deduction, and it applies to tax-qualified long-term care insurance premiums. With this policy, the long-term care rider qualifies for that tax deduction. Also, with this particular policy, the monthly premium is guaranteed to never go up. As they get ready to retire, they wanted that predictability and that certainty. So what benefits did they get? Well, if they need care, for example, let's say 10 years from now, the benefit will be $4,200, a little bit over $4,200 per month per spouse. They understand that won't cover the full cost of care 10 years from now, but combined with other passive income like Social Security and pensions, it could prevent them from draining the retirement accounts and other savings accounts. And of course, the monthly benefit grows every year. It's guaranteed to grow every year. If they need care 20 years from now, it would be at least $5,700 per month per spouse. In 30 years from now, it would be at least $7,300 per month per spouse. It's about $100,000 a year. The monthly benefit continues to grow every year for as long as they live. And these are just the guaranteed numbers. The actual benefits could be higher depending upon interest rates. Now, the way this product works, beginning with the 31st month of benefits, the long-term care rider kicks in, and it can pay for an additional 30 months of benefits. But the growth in this rider is even better than the monthly benefit in the annuity, because the monthly benefit in the long-term care rider grows by 5% compound every year. If the 31st month of care, for example, is 20 years from now, well, the long-term care rider would pay up to $7,600 per month per spouse. In 30 years from now, it's guaranteed to be over $12,000 per month per spouse. That's a lot of benefits. So what did this cost them? How much did they have to put into this to get these benefits? We did the trustee-to-trustee transfer from Paul's 401k into the annuity. They transferred $90,000 from the 401k into the annuity. There were no tax consequences since the transfer went from the trustee of the 401k to the trustee of the qualified annuity. And both Paul and Wanda are covered by this policy. That's important. They're both covered under it. Now, if they never need care, their beneficiary will receive the $90,000 plus interest. For example, if they both pass away, let's say 20 years from now, without needing any care, their beneficiary is guaranteed to receive $150,000. It could be higher depending upon interest rates. And the monthly premium for the long-term care rider with the 5% compounding inflation growth, how much does that cost? Well, it's a little over $200 per month. That's not $200 per spouse per month. That's $200 per month, and it covers both spouses. They got a lot of benefit for a reasonable amount of money, and it's safe. What if they don't want it anymore? What if they decide they don't want this product? What happens to their $90,000 then? Let's suppose that 10 years from now, they decide, we just don't want this anymore. They'll get back over $116,000. Basically, they'll get back their original deposit plus a little bit of interest. This is basically a no-lose scenario. If they need care, they win. If they don't need care, their beneficiary wins. If they decide they don't want it anymore, they still win. Thankfully, even though Wanda has chronic kidney disease, we were able to get her a product that perfectly suited her and Paul. If you've been told you can't qualify for long-term care insurance because of chronic kidney disease, go to my website, ltcshop.com. Click on Schedule a Call, and let's discuss your options. Thanks.